So, welcome to part 3 of my lecture on ownership. Last part dealt with the definition of an owner of a firm without ownership or with a firm with an owner. The difference between Pharma and Alkan Debset's ideas. Now we will continue more in the road of Alkan and Debset, and now we talk about the shareholder share market. And, I have some technical problems. Here we are. So it will be about socialization of ownership and the market, focusing on the shareholder as we know today. In this slide, I'm trying to show that originally, when the joint stock company started, there was this idea with the investor and the firm. So the investor invests in the firm. Maybe that could be also considered to be the traditional owner of the firm. Then arrives the corporation. We have the corporation here that have the ownership of the firm. And the corporation, since it's a listed corporation, has its shares listed on the stock market. So the stock market is actively influencing the corporation. And the stock market, that's where the investors are. So now you can see that there is a distance between the investor and the firm. And that is really the separation of ownership and control. But look at the third set of arrows. We have still the firm that is owned by the corporation that is listed on the stock market. But on the stock market, there are investment funds that are specialized in ownership of shares. And the investment fund, they get their money from the investor, those that put the money, for example, a pension fund, put the pension money in a pension fund that then invest in the stock market, that then influence the corporation, that then influence the firm. So we have a lot of layers between the original investor and the firm. And that is really a huge separation of ownership and control. In fact, that is what Karl Marx once said. That was why he liked the joint stock company, because he said the joint stock company is socialization of ownership. Socialization means that you go from individuals, the investor that are engaged in the firm, to corporations and organizations that are organizing faceless individuals called the investor in order to control the firm. So socialization in this sense does not mean that the government has ownership of a firm. Socialization means that the ownership rights are distributed out in society. And here in the middle it was distributed to investor through the stock market. And now it's stock market that is where investment funds are acting, and then there is investors behind the investment funds. So it's socialization. So today, most Swedish people that have employment and salaries, they are in fact capitalists, because they have a share in a pension fund. The pension fund had a share in a corporation shares that control the corporation, that control the firm. So when we are talking about the owner, who is the owner? Is it the investment fund? Is the investor? Well, in pension funds, you as an investor, you put your money in the pension fund. You have no right to influence what they are doing with their shares. So the pension fund, they can influence the corporation, but you cannot influence the pension fund. So that's I would say, the dark side of the socialization of ownership, when you have pension funds that have really a huge agency problem, because there is no one that really controls them. The investor do not control the pension funds. That is another story, however. But this is a way of showing that the financing of equity has been more and more socialized, more and more distributed out in society. The next slide shows I try to collect all different ways of financing cooperation. On the left side, you see how it can be organized with equity, who contributes with equity in a firm, and on the right side, it's the debt financing. So in the left side, those that are giving in equity to the corporation, we have the capitalist. Capitalist, according to Keynes, an old economist, said that you could divide capitalists, those that are acting on the market, stock market, between speculator and the industrialist. The speculator is the one that is looking at the market, trying to understand how the market is functioning. It's kind of psychology of the market. So they don't care about corporations. They are the ones that are doing this kind of analyzing, where they are looking at the share price, if it's going up or down. It's what you call technical analysis or something like that. And then there is the industrialist. Industrialists are those that are doing analyzing of specific corporation, and they invest in the corporation, trying to predict the future of a corporation, trying to understand their market and their strategy. And both of these categories of the market is needed, because the industrialist is typically one that invests and then keeps the share, that they are not selling and buying. The speculator is the one, the extreme speculator is the one that is buying and selling shares on the same day. Day traders. Day traders, they have a function. Of course, they can create a lot of disturbance, a lot of variance in the stock price, but on the other hand, they create liquidity to the market, and liquidity is very important in order to make it possible to have a more precise price of the corporation. Then we have the share markets as such, and the part of the share market that is the option market, where you can trade on particular features of the share. We have finance analysts and journalists I put here, and they are not contributing with equity, but they are contributing with information to the market, and therefore they influence the price of the equity, and therefore they are quite important. And last but not the least is the ownership arena for corporate control, since shares have not only profit rights, but they have also voting rights. In order, then you can buy shares and you can influence the corporation through these voting rights. And that part of the share market where you try to influence the corporation through the voting rights, that is what's called the ownership arena for corporate control. Considered sometimes to be very important, because if you have a lazy owner and you have a lazy manager, then you can buy shares and then you can change the management of the firm. On the debt side, there is those that are providing with debt, and one big debt provider is the input suppliers, those that give credit when corporation buys, then they have 30 days of credit. That is a credit, that is debt, that is an input supplier that contribute with their financing. And then of course we have the traditional capital markets in between, providing both equity and debt, depending on which economic system they belong to, is the business groups and the banks. I will talk in a later part of this lecture about business groups, and of course banks. We know they are providing debt to corporations. So that is one could say a quick draft of the finance structure of a modern corporation. Now, focusing on the capital market. The capital market has different functions. The shareholder capital that is provided contributes to the corporation and to the market with different functions. One function is, of course, the creation of profit and profit distribution, if there is any profit from the corporation for dividend. And the idea with the capitalist economy is that capital is attracted to those areas where there are expected profit. The second is risk. The shareholder assumes risk. As I told you before, there is this residual capital. Residual capital means that you assume the profit, the first one, but also the losses. And to assume the losses is to assume the dark side of the risk. When you lose money, then the shareholder has to provide with the capital. So that is the risk assumption, assuming part of the function of shareholder capital. The third one is rationing. Rationing is that you give capital to certain corporations because the capitalists believe that there could be a profit. Other corporations have a problem financing their operations through equity because no one would like to supply capital. So that's rationing. You distribute the capital to those activities that are considered to have an expected profit. The fourth function of share capital is the takeover, and that is because as a share you have not only profit rights but also control rights, and to gather a lot of voting rights, then you can take over the corporation. You can change the corporation, the board of directors and the management, and change the strategy of the corporation. Finally, the really strong part of the shareholder capital is bankruptcy. The beauty of a joint stock company is that the corporation can go bankrupt, and that means that all owners are fired. In bankruptcy, the shares are worthless. They are without any value. They are without any voting rights. It's the joint stock company will be dissolved, but the firm can still exist. So the operations in the firm can exist, but the owners are fired. So bankruptcy is the strongest mechanism of capitalism, where you fire all the owners. And then hopefully maybe there is someone else that comes and say, oh, I take over the firm, create a new corporation and become the new owner. Or maybe they divide the firm into different parts or sell out the parts. But the beauty really of joint stock company is that the firm can still exist and operate while the owners are thrown out because of bankruptcy and new owners arise. These are the functions of the shares. Of course, these are reflected in the stock market function. At a corporation, listed corporation, the stock market provides with many important things for the corporation. First, the stock market is really, you could say, a factory producing one product, and the product is price. That's the main thing with the stock market. That is the product of the stock market as a factory, to produce a price of an asset. And this pricing of assets, it implies then you can monitor firms and you can decide of capital allocation. If the price goes down, of course, other people tend to sell the shares because no, there is no future in this corporation. If there is a expectancy of high profit, as for example with Tesla now these days, the price goes up and goes up and goes up. So that provides capacity to monitor firms, to influence firms for the price. And then it's to provide risk capital. If you have a good idea, maybe you can present it for the stock market, and they will invest. Initial public offers, it's called, when a firm would like to be placed on the stock market, asking for more risk capital. And then the third, of course, the stock market encourage risk taking, because it's an opportunity to have investment and to get profit. And in a stock market, you don't have to buy a whole corporation, you just buy a small part. Even me, I can buy shares, and then I can diversify my portfolio of shares so I don't have the full risk of one corporation. It's a beautiful arrangement. But investment diversification, and when we invest in a corporation that we believe can create a profit, we are rewarding profitable investments. Fourth is the correction of managerial failure through the market for corporate control, and that is when you collect shares and then you invade the corporation and you go into the firm and change the firm. And fifth, there is a possibility to change a firm because there are differences between owners. Those that are owners and those that would be owners would like to be owners if the present owner, think that they have expected profit of $1, and the would-be owner can see, there's a possibility to have a profit of $2. Then the would-be owner can offer $1.5 to the present owner, and the present owner realizes that, well, I can make a profit of $0.50, and that changed the ownership. So these are the stock market functions. Of course, when you look at the stock market, how it functions, it creates investment bubbles, and it goes up and down. And you know about the Wall Street crash 1929, and we had a financial crisis more recently that were organized around the stock markets. So stock market creates a lot of trouble. I told my professor in economics, I don't like the stock market. It's very bad. It creates these bubbles and it creates the crashes and all these things. It's a really bad organization of financing. And he said, yeah, I agree. I agree of the criticism. You're right. It's not good. And Collin, what is your alternative? What can you offer that is better? And I said, yeah, I have no idea. So the stock market is like, I think it was Churchill or someone that said that democracy is lousy, but the alternatives are even worse. So it's really hard today to imagine an alternative with this enormous capacity of pricing, providing risk capital, encouraging risk, correcting managerial failure, firing bad owners to change firms than the stock market. But if you have an idea of an alternative, just present them for the politicians. And then if we focus on one specific part, that is the voting rights of the shares, that is when you can really gain control of the corporation and therefore influence the firm. So that is when you get control of the corporation through concentration. You buy a lot of shares and collect them together, those with voting rights. One would therefore think that an owner investment consists of two things. When you invest in a corporation, you invest with your capital, and then maybe you also invest with competence. You learn about the corporation, and if you learn enough so you can understand the corporation, then maybe you would like to increase your capital investment because then you can influence the corporation. Me, for example, with my shares in this steel corporation, I don't know so much about steel production and steel markets, so I don't have a competence. That could be one reason for me to not invest more capital in it and try to gain control, because I cannot tell them anything. But those that think that they have a competence, then they can increase their capital investment and then gain control for this concentration. And then, of course, if you do like this, if you do more investment in a corporation, then you get more investments, you get more specific investment, more of your capital and your competence is focused on one single corporation. That means that you are sensitive to what's happening in this corporation. You have then you have incentives to engage, because you have a hold-up situation. You are stuck in an investment, both in capital and in competence. So you have reason to be more engaged. Therefore, you have reason to concentrate your ownership and gain control. Because the reduction of the hold-up, when hold-up means that you are sensitive to other people's action, you can reduce it through ownership concentration. When you gain more ownership, you can control, and other people cannot control you. So then you get the ownership concentration if you have an owner that have a lot of capital that can be converted into voting rights, and that have a competence and ideas about how to develop the corporation. Of course, ownership concentration also means that there is a risk of minority exploitation. If you have a dominant owner, that dominant owner can use the corporation for the benefits of the owner, the single owner, instead of distributing all the wealth to all the owners. So that is the minority exploitation. It has been considered to be very important when you study, for example, Italian corporation. There are families that are dominating owners and they exploit the corporations on behalf of the minority owners. They have tried to study it in Sweden, but they haven't found really many examples of minority exploitation. So obviously the owners, the dominant owners in Sweden do not exploit the minority. And that is what is called principal conflict. So it's not a conflict between a principal, that is the owner, and the agent, that is the manager, but it's a conflict between different principals, different owners. And then we have the market for corporate control, and that is when you have shareholders that are gaining control through buying all these voting rights. And so there is a market for corporate control where you can buy the control of the corporation. And because the shares have voting rights, and that is tradable rights of control. That's also the kind of beauty of the joint stock company shares, where you have different profit rights and different voting rights. You can have shares that have the same rights to the profit, but one share has only 1/10 of the voting capacity as another share. If there would have been a perfect market, if all actors have been identical, so they have no excess information, and they don't have different capacity to value this information, then the value of control is zero. Of course, there is no value of control if everyone knows exactly the same thing and believes in the same thing. But there are costs for information. Some people can invest in this information gathering, other people don't. There are costs for theories. Theories, that is the competence. Some people are more competent than others how you analyze. But you have to, in order to get the competence, you have to create the competence, and that is an investment, so there are costs in order to gain the competence. And then fourth, there are preference differences. Some people have preference for higher risk, some for lower risk. So because of cost of information, cost of the competence, and preference differences, there is a value of control. And this value of control means that someone would like to buy shares to pay a little bit more than others, because they know something that the others don't know. They have a way to analyze this information that the other people cannot, and then they have different preferences. So this value of control is larger than zero, means that there is a market for corporate control. So that is when you make public offers to buy shares in order to gain control and try to influence the firm in the corporation. And that is considered in US to be a very important way of changing a corporation. It's not so distinct in Europe. We don't have this kind of lively market for corporate control. Instead, we have a corporate control that it's not a market, it's a social arena. That is when you change ownership, not through open fights on the stock market where you're bidding up the price of a corporation in order to buy the shares. Here we can say that you have a social arena where there are negotiations between owners and would-be owners, trying to find out and trying to find a price where they can sell and then the would-be owner gain control of the corporation. That is a different kind of arena for corporate control. If you're looking for something to investigate, that is my advice. Try to find out how the social arena for corporate control functions, and if probably it functions differently than the market for corporate control. So that was this part of the lecture, considering the share, especially the share market. I hope that most of it was a repetition from earlier courses, because you haven't been studying the share market before, but it's very important to understand the share market. It's the way how you finance the corporation through equity, and the way how shareholders can gain control of the corporation.